Something unusual is happening right now. Markets are not crashing, but they're not celebrating either. Stocks are volatile, interest rates remain high, and investors are stuck in a strange wait-and-see mode. And that uncertainty, that's where the real story is. In this video, I'll break down what's actually happening in today's financial world, quickly and clearly. No noise, no jargon. Just the key events, why they matter, and what they could mean for you. The problem today is not lack of information. It's the opposite. Every day you hear about inflation, central banks, AI, geopolitics, recession fears, but it's all fragmented. One headline says markets are strong. Another says a downturn is coming. So what's the truth? The reality is that financial markets right now are being pulled in multiple directions at the same time. On one side, economies, especially in the US and parts of Europe, are still holding up better than expected. Employment is relatively stable, companies are still generating profits, and consumer spending hasn't collapsed. But on the other side, we still have high interest rates, lingering inflation pressures, and global uncertainty, from geopolitical tensions to supply chain risks. So investors are stuck asking one question: are we heading toward growth or toward slowdown? And that uncertainty is exactly why markets feel unstable but not broken. First key trend: interest rates staying higher for longer. Central banks have spent the last years raising rates to fight inflation. Now inflation is cooling, but not fast enough, so rates are not dropping quickly. Why does this matter? Because high rates make borrowing more expensive for companies, governments, and individuals. That slows down investments, real estate, and economic expansion. Markets haven't collapsed. In fact, some sectors, especially tech and AI-related companies, are still performing strongly. But this growth is narrow. It's concentrated in a few big players, while many other sectors are lagging. That creates a fragile situation. If those few leaders slow down, the whole market could feel it. From conflicts to trade tensions, global instability is still high. Why does it matter for markets? Because uncertainty affects energy prices, supply chains, and investor confidence. And when confidence drops, markets react quickly. Here's the key idea, and maybe the most important takeaway. We are likely entering a phase where markets won't move in one clear direction. Instead of a big crash or a strong bull run, we may see a prolonged period of volatility, ups and downs, driven by data, news, and expectations. In simple terms, the easy phase of the market is over. From now on, markets will reward selectivity, patience, and timing much more than before. And here's the hot take. If inflation continues to slowly decrease without a major recession, we could see a delayed but more sustainable growth phase. But if something breaks, like credit markets or employment, volatility could quickly turn into a sharper correction. So right now, the financial world is not in crisis, but it's not stable either. High rates, selective growth, and global uncertainty are shaping a market that moves carefully and unpredictably. What do you think? Are we heading toward growth or a slowdown? Let me know in the comments. And if you want simple, clear updates like this, subscribe and check out my next video.